All right, good to see you guys. We're going to go ahead and get started. So it is 1 p.m. Let's go ahead and get things launched. Welcome to Sacred Account Saturday. It's good to see everybody here today. Thank you for tuning in. I'm Jerry Fetta, owner, founder, CEO of Wealth Dynamics. If you're tuning in for the first time, the purpose of this course is financial education. To learn the truth about money, stuff that I didn't learn growing up. You probably didn't learn growing up. And a lot of us, we should have learned. It was stuff in school that we could have, and we just didn't, right? And so, I grew up with a lot of heartache and problems when it came to money and finances. And so as I started learning about finances, I was like, okay, this stuff isn't actually that hard, right? And that's what I want to impart to you as we get started today, is that it's stuff that if you have, the ability to use a calculator and a dictionary, you can understand money, you can understand finances and begin succeeding with it. Right? A lot of it's a lot more simple than we think. And so as we go through this today, I'm going to be talking about some concepts relating to, how to self-finance our purchases using life insurance, how to become your own bank. And I want to just make sure that we all have, the right mindset as we get things going, right? So the first thing is that, in order to learn anything today, I want to make sure you've got a reason for being here and a purpose for being here. So if you're just tuning in, you've never seen this before, and you're curious, that's a valid reason, right? The other thing too is, if you're a client of mine and you're like, okay, I'm here, I'm attending, I want you to think about, how does this apply to my finances? How does this apply to my next step on achieving greater financial freedom, right? Am I trying to pay off debt? Do I have a large purchase coming up? Am I trying to invest? Like, what is it that I'm going after? And how do I apply this? Because information that we learn and don't immediately use and immediately put into application is basically not worth learning. And if we're not using it, for me personally, I would argue that we're not actually learning, because learning would mean use and success. And so if we're not using and succeeding with information, we didn't actually learn anything, right? So I want to make sure we have that first. The second thing is, I want to also get rid of the idea that money is complicated and confusing. So like I said, if you can use a dictionary and a calculator, you can understand this stuff. For decades or not for decades, sorry, for years, I'm not that old yet. For years in my life, I've been working with people on finances. And that's one of the first things I hear from the average person is, I could never understand finance. Money is confusing. It's a topic that I've never really been able to understand. And here's the reason why, right? So all of the financial everything is basic math: add, subtract, multiply, divide, right? So that part's not hard. Like, we all learned that in like second grade, third grade. Maybe for some of us, it took a little bit longer, but that's the reality of it. And so when we think about it that way, why would that be confusing? I had 3 bananas, I added 2 more. How many is that? Like, that's not that hard. Or, if I have a calculator that says, okay, I have 10 bananas and I have, an increase of 12% of the bananas on an annual basis for 20 years. If we have a calculator, we should be able to understand and figure out how many bananas will we have in 20 years, right? If I have 5 bananas and I eat them all, and I was going to make banana bread with them later, I would have no bananas left and I couldn't make banana bread. That's saving money. If I use all the money, there's nothing to save, right? So this is all very simple stuff. And the reason why it can be confusing is vocabulary, right? Banks and Wall Street, they've put together an excellent campaign of making money sound more confusing, right? Because when things are confusing, we don't win with them because we don't understand the words being used. And then we have to go to the authority that does understand them and pay them for their help. Okay. And sometimes, that's done through fees, like with banks and Wall Street. Sometimes that's done through taxes. Sometimes that's done through protection. Now we're talking governments, right? So when we use, a dictionary, okay, what does this word mean? Let me look it up. That's what it comes down to. What does that word mean? Let me look it up. Let me find out what it means. What's the math? Let me put it in a calculator and see if I can figure it out. These are the things that we've got to be ourselves responsible for doing. Okay, because nobody's going to do that part for us. If we don't understand what a word means, like, there's not very many people in our lives that are going to stop and be like, hey, let me explain this to you, right? So that's the first thing I want to make sure we have down as far as being able to learn. The second thing is getting rid of the idea that we know it all, especially if you're a client, you've heard about the sacred account before, right? If you're brand new and you've seen it on TikTok or YouTube, it's been also, called the infinite banking concept and cash flow banking. There's all sorts of names for this concept, right? But the idea that I know it all, I've heard this before, I know it all. After my webinar today, I'm going to the gym, right? Now, why would I go to the gym? I already worked out once this week, right? Like, that's not how it works. I've got to go every day. This is not, so this is kind of like that. It's not something where I can be like, oh, I already learned about that once. I already heard that once, right? Like repetition brings that certainty so we can actually apply information and use it and get more and more competent with it, right? Competence creates speed. So when I'm looking at this, like I talk to clients sometimes, they're like, man, I really want to go fast with my finances. Good, you need speed. How do you get speed? Competence. How do you get competence? Doing the same shit over and over and over again until you get fast. That's all it comes down to, right? So I want to make sure we cover that first. The second thing, or sorry, the third or fourth thing, I guess this would be the next thing I want to go over is if you're watching and you're not yet a client, my intention is for you to become one, right? So I want to offer you a free copy of my book, Blueprints of Financial Freedom. You can get that in the comments, in the chat. But this is what it looks like. So this is Blueprints of Financial Freedom. If you go to jerryfetta.com/B2F promo, you can get a copy of this book. We're going to cover some really good stuff on the webinar. We're not going to be able to cover everything, right? So the book's going to go through the rest. And so this is part of, taking action on finances. If I learn it, seeing once on a webinar isn't going to change my life. It can give me the introduction to a concept that could change my life, or to a team, or to a group, or to a person. And if I follow that up and follow that through, that could change my life, right? But it doesn't just happen like this. So I want to encourage you, grab a copy of my book, okay, Blueprints of Financial Freedom. The way that you're going to do that, let me push the link here. Let me type it here in the screen. So if you go to jerryfetta.com/B2F promo, you can get a copy of my book. And then finally, before we get started, I do want to introduce two people on the webinar. So we have Rodrigo Torres and we have Nano Aquino. Rod and Nano both work for me. They're staff of mine. They're also clients at Wealth Dynamics. Nano's been with us almost 4.5 years now. He's been working with almost all of our clients know who Nano is. Like if you're a client, at some point you've spoken with Nano. So Nano is going to be reaching out as well in the chat. And if he sends you a message, same thing with Rod. I'll introduce who Rod is in a second. If Nano sends you a message, it's because he wants to connect with you for a call, right? So check your chat. If you're a client, he's probably checking in to see if you have questions, if you want to do a consultation with them this week. If you're not a client, he wants to earn your business. He wants you to become one, right? We're not going to be coy about that. If you're watching this, we want to make sure you do become a client. You get the book, you connect with Nano. Now, Rod has worked with us going on maybe 6-9 months now. Rod has about 22 years of experience with building organizations, recruiting, selling, servicing. Rod is kind of like one of those Swiss Army knives where the guy literally can pretty much do anything. And so we've been very happy to have him on our team as well. So if Rod reaches out to you, same thing, he's trying to connect with you for a call, right? So you'll probably get a message from him in the chat. I will probably remind you guys to check your chats throughout. And so that way you guys can connect with Rod and Nano. All right, so without further ado, let's talk about the concept of self-financing our large purchases, right? Victory asks, do you have an ebook? We do have an ebook. So reach out. So Nano or Rod, if you could reach out to Victory in the chat here, Victory Ledgerwood, and get her connected with the ebook, him or her. I haven't seen Victory yet. So if I got your gender wrong, my apologies. So connect with Victory in the chat. And then basically the other thing I do want to go over is ask questions. We want this to be a communication between you and I. So I am the CEO of the company. I don't always get to talk to everyone. I like to go live on the microphone, answer your questions as we do these training calls every Saturday. So if you have a question, don't hesitate to drop that in the chat, and we'll make sure that we do, mic up at some points, and then we go over that together. So let me talk about what we're going to talk about today, which is the sacred account, right? So we've talked about this before. I want to just quickly do a visual refresh on what the sacred account is. Okay, so here's how the sacred account works. So it's high early cash value dividend paying whole life insurance. It's a very specific kind of life insurance. Because it has such a long name, we just call it the sacred account. And the reason we decided the sacred account is because it has a sacred purpose. We are not using this like a bank, right? If you think about the average person that uses a bank account, they kind of accidentally save money there, right? Like we get our income, we get our paycheck, and then what happens? We spend it, and then what's left over, we put in savings. And so saving becomes an accident, which means that wealth becomes an accident as well. I can't, so to build wealth, I've got to earn, then I've got to save, then I've got to invest. And so if I don't save, I can't invest. If I don't invest, I can't build wealth. So it's very imperative that I save. Most of us earn, the average person watching here probably has income. And so it's like, okay, well, I earn, what do I do with it? Well, if I spend it all and then save what's left over, I'm saving on accident, which means that if I ever really do invest, that's also going to be an accident, which also then means if I ever become financially independent or wealthy, that's also going to be an accident. And we wonder why it's called the top 1%, that 99% of people don't achieve it. Well, it's because 99% of people are leaving it completely up to chance. It's an afterthought, right? So when we look at, okay, what is the sacred account? It's not accidental saving. So a couple features here. The sacred account is a forced savings plan. So this is the first thing that's different, is it's forced. It's going to happen every month, no matter what. There's no way to not have this go into your sacred account once you set it up. The other thing is it's automated. Okay, I don't have to think about it. I don't have to do it. It just happens, right? Who's ever had a car payment or a mortgage and you put it on autosave, right? Like we do that because it's usually like a way to not have to think about it. It's a little bit more maybe financially responsible, where we make sure we don't miss the payment. So then we're sending that money, like for a car payment or a mortgage, we're sending that away. That's an expense that's going to the bank. That's their money now. Why would we automate paying other people and not automate paying ourselves? Think about this. I was never taught this. So this was like, I'm not making you wrong. I'm saying I was never taught this. Okay. I got a car payment and that was the first thing they said, put it on auto pay. Same thing with my car insurance, put it on auto pay, right? Rent, put it on auto pay. Phone payment, put it on auto pay. Why? Because everyone else knows that that's how they get paid. Even our taxes work this way, guys. It's on auto pay. We have the taxes taken out of our paychecks before we ever get paid. It's on auto pay. So why would the most important part of our budget, savings, not be automated? Like I want you to think about that. If it's not currently automated, why isn't it? And what would life look like if you had an automated forced savings plan that, just like your rent, just like your car payment, just like your mortgage, would just come out every month and you would just have it there, right? So we have forced savings. It's automated. This is something that's guaranteed against loss. Okay, guaranteed against loss. This is a big one. Not many things can guarantee against loss. And if they can, you have to ask, like, what's backing the guarantee, right? So you could say a savings account guaranteed against loss, right? It's FDIC insured. It's a bank. They have all these things that back it up. Well, FDIC insurance is underfunded, and also it's paid by taxpayers. So how is that guaranteed? You're going to pay for your own loss. Before the government will bail banks out, the banks are forced legislatively now to do what's called a bail-in, meaning they will keep your deposits in order to keep the bank solvent. So the guarantee is your money. It's either they're going to keep your deposits or an insurance policy is going to pay that is funded out of your taxes. So the life insurance is not that way. They're guaranteed against loss because the companies are solvent. The insurance companies have I think New York Life, for example, financially speaking, they're the size of the country of Kuwait. Like they could literally buy Kuwait and several other countries if they wanted to. So they're very solvent. They have, a Mass Mutual, for example. I think this was the last time I looked at this specific number. They were near $30 billion just in cash reserves. Not assets, not investments, cash reserves. The money that they actually save, an insurance company saves to set aside to pay out their policyholders, they count that on their books as a liability, meaning they actually really do have cash, but they count it as a liability because they're like, no, we already know that this is going to be to fund our policies, right? Like imagine you having an emergency fund for your mortgage. You're like, okay, this is being set aside to pay my mortgage payments. And you considering that money that you actually really did save was a liability, not an asset, because you knew that it was already going to be devoted to covering a cost. That's what these insurance companies do. So they're guaranteed against loss. They're guaranteed to gain. Right? Now, again, this is a cute thing. Anyone can say this. But at the end of the day, it comes down to what's the actual track record, right? Guaranteed against loss. These insurance companies have been around for 150, 170 years, never lost money. So it's like one thing to be like, I guarantee this, and then you've been around for 5 years and it's like, okay, well, we'll see how that guarantee pays out. But it's another thing entirely to be like, I guarantee this, and also I followed through on it for 170 years in a row. Right? Like that's two different conversations there. They're guaranteed to gain, same thing. They've made money every single year. They've never lost, they've always gained. Right? When I say made money, I mean like they paid dividends to shareholders. They actually, like if you put money, you in the policy, you made a return. Right? So that's super important. They're not taxable. Love that part. So money that you put into an insurance policy or a sacred account, you're basically taking it out of the tax system forever. It's no longer part of the game of I made money, I pay taxes on it. So the money you put here is the money you never want to pay taxes again on, right? So it's not taxable. It's protected from creditors. It is protected from lawsuits. And it's completely private. This is what's called a unilateral contract. When you take loans, that does not get reported to the IRS. Your account is between you and the insurance company. It's not public information. This is like, and it's contractually private. It's not like we made a sneaky little thing and nobody knows about it yet. And when they find out, it's not going to be private anymore. No. This is like, it's known about, and it's in legislature, it's in the laws, it's rule that this is private. This is unilateral. It's between you and the insurance company. There's one party to the contract, and that's you. Right? So this for me, already when I talk about where I'm going to save money at, is the best place I could save. It's the safest place for me to put my money. This is the place that I'm going to put my money that I never want to lose, and I always want it to grow for the rest of my life. Right? Which, to be totally honest, for me, isn't that kind of all of it? Like I don't want to lose any of it if I don't have to. Right? I want to grow all of it if I could. Right? So I want to put as much as I can here. This is just like the features of the account. Let me show you how it works though. Okay, so there are a couple of things to know about the sacred account. When I put in money, so let's say that I put in $10,000 as a deposit, and this goes in, okay? This $10,000 is now going to grow at about a 3 to 5% annual rate per year, tax-free for the rest of my life. Right? This is, again, guaranteed to grow, guaranteed not to lose, guaranteed it's not going to be taxed, right? Like, so this is big. Like this 10 grand will always make money for the rest of my life, no matter what. Okay. Now, the great thing on this, and I'm going to show you like how you can leverage this to earn even more. But when I look at the average savings account, like savings account rate paid on a bank, if I put that $10,000 in, my first question is, okay, well, how fast is my money going to grow in an alternative? Most people will put it in a bank, right? So in a bank, currently you're getting 0.01% per year, right? The decimal version of this is you're getting, 0.0001. All right. So there's this thing called the rule of 72. Okay. The rule of 72. And this basically shows how fast your money will grow at a certain rate of return. So I take the number 72, I divide that by the decimal version of the rate of return, and that tells me how long it's going to take for my money to double. So in this case, I put in $10,000, and I have 72 divided by 0.0001. Okay, this means that it's going to take me 720,000 years to double my $10,000 in a bank account. Like, think about that. Like, this is longer than banks have existed. 720,000 years. There's not going to be a bank account. Like, who knows what's going to happen in 720,000 years? Okay, I'm going to tell you guys a quick story. When I was 19 years old, I learned about this. I was about a year into being in financial services, and I didn't believe it. So I called the banks and I was like, what's your savings account rate? And they were like, at the time it was a little higher. I think they were like, oh, it's 0.50%. Right? And I was like 0.50%. And I did the rule of 72 on that. And I was like, it's like some ridiculous number, like 14,000 years or 100,000 years or something like that. And I was like, did you know that it's going to take you guys to double my money with you? It's going to take you like 100,000 years or something crazy like that. And I'll never forget the lady on the other end of the phone. She's like, yeah, it's just the economy is really bad right now. And I was like, even if you increase the returns, like you bump me up to a full percent, like that's not going to help me at all. Right? So this is where most people save. Now, same thing with the sacred account. We look at, okay, we're growing at a 3 to 4% annual rate. Let's just say 4%, just to meet ourselves in the middle there. 72 divided by 4. This means that my savings will double every 18 years, right? So 720,000, let's divide that by 18. We're growing our money 40,000 times faster. Okay, think about that. Because when I first saw this, I was like, well, 3 to 5, it's not that much. I could invest in the stock market. I could put it in real estate. And here's the thing, you also can do all of those things. I'm going to show you how you do both. This is the have your cake and also eat it too plan. But I'm just saying, like, for the interim, where you're going to store your money at, this is going to be 40,000 times faster, more growth, right? Like, this is a big deal. Okay. Now, here's how you would do this. You can borrow against this account as well. So let me just get rid of all of our bank stuff here just to keep things clean and less confusing. So you can borrow against the account, meaning I can take a loan against my $10,000. I can typically borrow 70 to 90% of it from day one. As the policy grows, I can borrow more and more and more. At a certain point, I'm going to be able to borrow more than I even put into it, which is awesome, right? But here's the thing. When you have an asset growing, in this case, it's growing, let's say at 4%, I've got 10 grand growing. If I were to withdraw my $10,000 and take it out, I don't keep making 4%, right? Like, same thing with a bank account. They're paying me 0.01%. If I were to withdraw my savings from the bank and take it out, I'm not going to keep making the 0.01% because the money's not there. Okay. So that's the first thing that happens when you withdraw money from an investment, is you don't earn money on that money anymore. Not even just an investment, just an account, right? Like, and it's a very simple concept. If I have a car and I sell the car, I can't drive it anymore. If I have food and I throw the food out, I can't eat the food anymore. Like, it's the concept that if I got rid of something and it's gone, I don't have the use or control over that thing anymore. Right. So this is the same thing with money. If I have 10 grand in this account, then say it's growing at 4% and I withdraw my money, meaning I actually physically pull my $10,000 out, I'm not going to get paid on money that I don't have anymore. Right. So this is one of the first reasons why we borrow against it. When we take a loan against an asset, we didn't actually withdraw anything. My 10 grand is still all there and it's still growing at that 4%. Right? I'm using, in this case, it would be $7,000 to $9,000. Let's call it 8 grand, just to split that down the difference too. So I'm using $8,000 to go do smart things with, while my 10,000 still keeps making 4% like it never left. Right? So this is the first thing that blew my mind. I didn't know you could do this. Now, this is not just with life insurance. You can do this with a home equity line of credit. If I have a house, it's going to appreciate over time. If you live in Florida, for example, historically, real estate appreciates at 5-6% a year over the long haul, right? So if I can, borrow against my house and I know it's going to keep appreciating, then I can make money with that home equity line of credit. My house still appreciates. Same thing if I own gold. I can take a loan against my gold. Gold will go up in value over time. And I can go do smart things with the money that I've borrowed, knowing that gold's going to keep going up. Now, the question is, what do I do with this 8 grand, right? And we'll talk about that in a second. But that's the first thing to realize is, in order to keep earning money on money that I'm using, I take loans against it rather than withdrawals. Okay. The second thing is, loans are not taxable. This is not taxable. The IRS cannot tax a loan. So again, if I'm making 4% on my 10 grand and I make profit and then I do a withdraw, I pull the money out of the account. I pull out my 10 grand. Number one, it stops growing. Number two, I pay taxes on my gains. Same thing with a bank, guys. Like, if I have $10,000 in a bank, that measly 0.01% rate of return that they're paying me, when I pull the money out, they're no longer going to pay me. And if I made more than $10 in interest for the year, I will pay taxes to the IRS on my $10. Okay. So by taking a loan, it's not taxable. Like, think about when you get a car loan, they don't tax you for the value of the car. When you get a loan on a mortgage, they don't tax you for the value of the house that you're borrowing against, right? Same thing with life insurance. If I get a life insurance policy and take a loan against it, they're not going to tax me on that loan because it's not income. It's not a gain. I didn't actually get anything. I got a loan. My money's still in the account, still growing. So this is one of the tricks of the wealthy. Elon Musk did this last year to pay his taxes. He took loans against his Tesla stock, right? Apple's headquarters is in Ireland because Ireland was a tax haven. They set up the corporation there. All their profits flow to Ireland. They pay no taxes. When they need to bring money back to the US, all the US locations, by the way, are franchises and LLCs. They borrow against the Ireland corporation, and then they basically loan that to their US companies so they don't have to pay taxes in the US. Brilliant move, right? So you can do the same thing with a life insurance policy by taking loans. Now, the question becomes, what am I doing with this money that I've borrowed? Okay, there are three main things you can do. You can pay off debt, right? So if I have consumer debt, we're not going to talk about that today because we talked about that last week. If I have consumer debt, I could use the $8,000 to pay off the consumer debt, still keep making money on the money that I put in the first place, like it never left, save on the interest, get rid of the minimum payments, and be debt-free, plus have my money growing like it never left. That's the first thing we can do. The second thing we can do is we can make large purchases, right? So what does that mean? That could be a couple things. I could do a vehicle. Let me go back to my whiteboard here. I could do a vehicle. I could do this with furniture. I could do this with personal development costs. I could do this with wedding. So let's say I have kids and they're getting married and I want to fund their wedding. I can use that. I don't know why this keeps on moving my whiteboard. I could do this with a wedding. I could do this with college. I could do this with business expenses. Right? These are all things that, generally speaking, are larger than normal purchases. They're what I would consider to be like a one-off type purchase. Like I'm not buying a car every week. I'm not buying furniture every month. It's like, once in a while, this will come up, right? And I'm going to either need to do what? I'm going to either need to, number one, pay cash, or number two, borrow money, right? True or not true? When someone buys a car, usually it's either going to be they paid cash or they had to go borrow money from a dealership or a bank, right? Same thing with furniture. When I finance a couch, my couch back here, you probably will see my dog sleeping on it. This couch back here, I actually bought this with my life insurance policy. Okay, so that's a couch. I'll use this as our example. So I think maybe this whole set costed us like $3,000. Most I've ever spent on a couch. The couch, I'll tell you guys real quick. The couch that I had in Anchorage was, and this was the Walmart special. We had a couch in Anchorage. We moved. We knew that we were probably leaving the state. And so I was telling Lexi, I was like, I don't want to spend a bunch of money on a couch. Like we're literally going to put our butts on it. Like it's not something that has that much value to me. So I went to Walmart and I bought like one of those click clack futon couches for like $128. And it was the least comfortable couch I've ever sat on. I didn't finance that one. So when we moved to Florida, we moved into this place. If you had ever been to my house, we actually had beanbag chairs. We still have them behind us. We didn't have a couch because, again, I was like, I'm not spending money on a couch, right? There's another one behind me. I'm not spending money on a couch because the couch is not worthwhile. Like we're literally like, we're just going to put butts on it like that. Honestly, it's gross. It's just going to get nasty over time, right? So Lexi finally was like, hey, we need to get a couch. I'm done with the beanbags. It was starting to hurt my back and neck when I would sit in it because the beanbag doesn't offer great support. So we're like, okay, fine, we have to get a couch. So I'm looking at it and I'm like, okay, if I have to get a couch, we're going to use our life insurance policies. And so this is what we did. The couch was, like I said, about $3,000. So this was the cost of the couch. We'll call this COC, cost of couch. Right, so that's over on this side. And so over here, I was looking at a couple of things. I was like, okay, so we could pay cash for the couch. Let's look at what happens if we pay cash. If we pay cash for a couch, we buy the $3,000 couch. So we've spent $3,000. And over time, this couch is not going to be worth $3,000. It already isn't. They sell it for more than it's actually worth. So I already lose money as soon as I buy the couch. So I'm looking at this and I'm like, okay, so, this is in year one. Let's say all the way down here, like year 5, when we need a new couch, we could sell this one, but it's probably going to be worth like $800 because it's 5 years old and gross, right? And so what I've effectively done when I pay cash for a couch, this is the same thing with a car. This is the same thing with anything that goes down in value. I've done a financial magic trick where I've taken $3,000 and turned it into $800. The disappearing act with my money, right? So this is paying cash. Usually I was taught paying cash was a good thing. You pay cash for things, yada, yada. you don't have a payment, right? So I was like, okay, well, I don't want to turn $3,000 into 800 bucks. Because I'm thinking about this from the standpoint of the life insurance policy. I'm like, if I put that $3,000 in my life insurance policy, that's going to grow at 3 to 5% every single year for the rest of my life. If I spend it on a couch right now, instead of putting it in the life insurance policy, I will never see the future value of that money. That's how I think now, right? And so it's, for me, it's been, 10 years in the making, 11 years in the making, but that's how I think now. So that was option number one. Option number two looked like this. I was like, okay, well, they do offer a loan, like they offer financing. So we could do this. We borrow money from, the bank or from whoever. And so then we go use that to get the couch. And technically we put $0 down, but every single month for the next 5 years, we're making payments, right? So we have principal and interest every month for the next 5 years leaving. And so in year 5, what do I have? Well, in year 5, I have a couch that still is only worth $800. I've paid $3,000 in principal, plus I've paid interest. Right? So let's say that over 5 years, I paid $100 in interest every year. So that means that I lost $500 to interest costs as well. Right? So if the couch is worth $800 and I just spent $500 on interest, I've got basically a net of $300 left. So that's another disappearing trick, right? Over 5 years, I turned $3,000 into $300. Not good for me, right? Now, here's the crazy thing. People do this with cars. People do this with home remodeling projects. People do this with all sorts of things. Who wins on this scenario? If I pay cash, that doesn't help me. That helps who? That helps the person obviously selling the object. It also helps the bank, because the money then goes into a bank account with them, the guy that sold this to me. The bank's going to trade it, invest it, loan it out, make money with it. The other thing, if I finance, the bank's going to directly make money on that one, because all this interest I'm paying is going directly into the pocket of the bank, which, by the way, the money they loaned me for the couch wasn't even theirs. It belonged to someone else. It was their deposits. Right? So this is like this was a conundrum for me. Like I remember at the age of 20, like being mentally stuck on this with a car. I was like, how do you win on buying a car? It seems like no matter what, you're going to lose money on a car. You pay cash, in 5 years, it's worth half what you paid for it, right? You finance it, in 5 years, it's worth half what you paid for it. You had a car payment, you paid interest, and you're going to need to sell it still. It's worth half. And either way, in 5 years, you're going to have to go buy another car and go through the whole thing again. It was like a trap. I couldn't figure it out. Okay. So here's what I did instead. I said, okay, let's get rid of all the nonsense about paying cash for a couch and using credit cards or getting financing. And instead, I'm going to use my life insurance policy. Okay. So I have my sacred account over here. I'm going to take a loan of $3,000 from my account. Boom, go over here with my $3,000 and I go and I buy the couch. I now have a couch, right? Now, here's the thing. My $3,000 is still making 4% on average over the long haul on an annual basis while I'm using it to buy this couch. So in 5 years, let's just do the math on this. If I have $3,000 growing at 4% for 5 years, that means that in 5 years, just on this, I have $3,600. To be exact, $3,662.99. Now, when I take a loan against this, I am going to have to pay interest. I'm borrowing against it. Now, here's the thing. When I borrow against the life insurance policy, if I do this correctly, I'm earning about 4% on average. My cost of interest is about 2%. So I'm making +2. What's 4 minus 2? It's +2, right? So I'm making, a profitable percentage to borrow against my cash value. Now, here's the other thing. Who am I paying the interest to? I'm paying it to the insurance company. I own the insurance company. As a policyholder, I'm a shareholder in the insurance company. So before we were talking about, just get a bank loan. Okay, I don't own the bank. They don't pay me a dime for that loan. I don't make profit off their profit. With the insurance company, when I do a policy loan, the interest I pay does go to the insurance company. I'm an owner in the insurance company. It increases their profits and they pay it back to me as a dividend. It's the same concept of if I owned a grocery store, I wouldn't go buy groceries from someone else's store. I would buy them from my own store because I'm going to have to buy them anyways. So I might as well benefit from it, right? Like if I go buy apples from my own store, at least that money goes into my company and I get profit from it. So this is not a question of what I want to pay interest. You're already paying interest. If you use cash, your cost of interest is called inflation. If you use debt, your cost of interest is called interest. If you use this, not only is it a profitable spread, but the interest you do pay goes to a company that you own and get the benefit of. Right? So here's what I'm doing. I took a loan for $3,000 against my policy, bought the couch. Okay. So in 5 years, this couch is still worth $800. And that puts me at 36.62, 99 cents plus $800. I have $462.99 to show for my couch. Right? So here's the magic trick. And you might look at this and you're like, well, what about the cost of interest? Sure, let's include that really quick. So if I have a 2% cost of interest, the difference of $300. Okay, so let's just turn this into 4,100. So even after paying the interest, I have $4,100. Okay. So scenario one was what? Pay cash. Took $3,000, turned it into $800, have a smelly couch at the end of 5 years. Right. Number two, borrow money from the bank. Okay. Paid $3,000 for a couch over 5 years, paid interest also, have a couch that's worth, $800, but I paid $500 in interest because I financed it on either the dealer financing or the bank or the credit card or the whoever. So I took $3,000 and I basically turned that into $300 versus doing it with the life insurance. I took $3,000 and turned it into $4,100. Right. So this is the difference, guys. And this is not that hard of a concept. We just have to think differently. We have to think about it like the bank does. We have to think about it the way the bank would. So when the bank loans out money, they're looking at, okay, what's our spread? What are we making? Right? Are there payments coming in? Is there interest earned? And so instead of thinking like a consumer, we're like, oh, I want to avoid payments. I want to use cash. No. I need to do what's the most profitable thing? What's the most profitable option? And the most profitable option on this scenario is to use my life insurance policy. Now, if we increase the numbers, let's say that we did this with, instead of a $3,000 couch, we did it with a $30,000 car. We can just add another zero behind everything, right? Like at the end, if I pay cash at the end, I turned, $30,000 into $8,000. If I financed it, I turned, $30,000 into $3,000, right? The depreciation rate might not be as bad on a car as it is a couch, but I'm still losing money at the end of this. But if I use the life insurance, I take a $30,000 purchase and I turn it into $41,000. Like this is how you make money. And here's the thing on this. There's not risk involved. Like this is different than you saying, okay, I'm going to borrow money and I'm going to go invest the money. And I hope that deal pays a good return and I make money and all this stuff happens. That's got risk involved. Not saying don't do it, but I'm saying that there is factually risk involved. Me buying a couch, there's not a risk there. Me buying a car, there's no risk there. Like I was going to buy that thing anyways. That was going to be a cost for me anyways. And so by doing it this way, right, I can actually make money on it and it's a risk-free rate of return and it's something I was already going to do. So you don't need to be like going out of your way and learning, okay, how do I do real estate? How do I do stocks? How do I do, crypto? How do I do foreign currency? Not saying any of that stuff's bad and you shouldn't learn about it, but I'm saying the next gradient, like the first gradient is get out of consumer debt. Because that's already an investment. You save those interest dollars, you keep those minimum payments, you make that money. Right? So I'm looking at this and I'm saying, okay, that's the first thing I'm going to do. If I have credit cards, if I have student loans, doesn't matter. I'm going to use my life insurance to pay those things off. Number two, what are my large purchases? Okay. Do I have a wedding coming up? Do I have a car that I need to buy? Do I have a down payment on a house? Do I have, a business that I'm trying to start? Do I have marketing costs I need to start? Guys, I've done this with personal development costs, right? Like when I do personal development, and I'll be totally transparent on this part because this is my mindset with it. When I do personal development, I take money, I invest it in learning something or improving myself. That's a financial investment in Jerry Fetta. And my mindset is that I owe myself now. Like I'm now in debt to myself. I expect production. I expect an increase. I expect the stats to go up because I made that investment. So I'm going to self-finance with my life insurance policy to ensure that I pay myself back, that I yield more income than I invested, right? I've always been my best investment and you guys always will be too. Okay, so I do it with that. You could do it if you have a business and you're like, okay, I want to do a marketing campaign. Okay, we want to do a push with, let's say, Facebook ads, or we want to do a public relations campaign and get on podcasts, and that's going to cost us, $10,000 or $12,000. I've done this where I've done that. I'm like, okay, great. That's going to be a great return on investment. Let's do it. Let's take a loan for my life insurance policy and fund it with that. Okay, the greatest thing with the business stuff is it's also tax deductible. So you have like the increase of whatever you brought in from, investing in the company, investing in yourself. And also you get a tax deduction on it, right? So those are all things I'm looking at. So really quickly, what I want to do is open this up for some questions. I do see that some that came in the chat. So if you put a question, we will mic up here. All right, good to see everyone. Avery, good to see you. Lawrence, good to see you. Victory, good to see you. That's such a cool name. Let's see. And again, guys, if Nano or Rod reached out to you, check your chat, check your direct messages. So Rod, make sure you get the ebook over to Victory if you didn't already. Okay, so we have a question from Nicholas. Let me bring Nicholas on here. All right, let's see if we can mic up with Nicholas and answer his question. All right, he might not have a mic, so I'll go ahead and read his question here. So Nicholas asks, it took me 3 months to get my first life insurance policy. Will it take that long for the Sacred account? I'm a client waiting for Guardian. Yeah, so that's a good question. So Nicholas, I don't know if you did your first policy with us or not, but I'll kind of just break down the timeline. So with getting a company policy or an individual policy with Guardian, you're being basically brought into the company as a shareholder. So that's the first thing, is they're basically making you an owner in their company. They're not just going to be like, cool, you're in, right? Like imagine if you had a company and you were bringing in a partner, you wouldn't be like, yeah, I don't know anything about you and you could be a criminal or a terrorist or a terrible person. Of course you can come in and own part of my company and get part of my profits. So because you're being made a shareholder, they're going to go through a couple of big things. The first one is going to be anti-money laundering. This is where they check your background for, anything they need to know about bankruptcies, crimes, like that kind of stuff. And then they're also going to look at where did you get your funds from, right? They don't want to bring someone in and then find out it was Pablo Escobar. The second thing is they're going to do financial review with you. They want to make sure you actually financially can afford the policy. Okay, so the financial review will happen. And then the third thing is going to be a medical review. And the reason they're doing a medical review is obviously there is life insurance being purchased on your end, right? And so that will have to pay out based on your health. If you're healthy, it's a less risk that you're going to die soon. If you're not healthy, it's like, you might die next week. They don't really want to put insurance coverage on you and have that risk and that cost right away, right? So these are the big three things that are going to happen. Each of these is going to take about 2 weeks. Right? So sometimes it can go faster, sometimes it can go slower. It all really depends. The anti-money laundering side of things, this is how quickly can we get the information from you to us to them. Same thing with the financial review. They're going to look at your finances. That's information going from you to us to them. The medical review is honestly the one that takes the longest because they can't get that information from you or from me. They have to get it from your doctor. And so that means that they have to get in communication with your doctor. Your doctor has to produce records, send it to them. Most of the times the doctors don't store the records in their office. They have warehouses they use. So it's got to get pulled from the warehouse, shipped there, transmitted that way. And then sometimes the doctors don't answer and it's a pain in the ass to get a hold of them. So this is the one that takes the longest. And if it takes a while, it's usually going to be because of this, right? And then the other part of the medical review is they do underwriting. They're going to have a medical underwriter come out, do blood, urine samples. They might have you do a spit swab instead of the blood and urine, depending on where you live. And so that takes a little bit of time to review also, right? But about 4 to 6 weeks is on the fast end. It could take 3 months. That's very normal. But to make it go quicker, just be in contact with our team. The more quickly you can get information to us, the faster we can send it to them. We do have an exclusion where if you've done a policy within the last 2 years, depending on the company, oftentimes you can skip the medical, right? They don't need to do a paramedic exam. It was done within the last 2 years, it's fine, right? So that's a way to speed things up for sure. But again, just the mindset of this for me, when I first set it up, I don't like needles. I didn't like the idea that I had to get my blood sample taken. Peeing in a cup was also a little bit weird, right? Those were all things that were strange, but I was like, okay, they're literally helping me set up my own bank. My business, for example, it wasn't instant to get it set up and profitable, right? And so I had the same mindset with this. It's going to take some time to get this set up because it's not like we're just putting together, this quick, easy thing. We really are putting together an entire financial system. All right, let's see what else we have for questions here. Victor asked, will there be a replay? There will be a replay on my YouTube channel, and then we do send that out on our email list too if you're subscribed to that. Daniel says, in order for one to follow this, they'd have to think as an investor versus a consumer. Banks want consumers. Yeah, banks are owned by investors. Their customers are consumers. So we have to get out of the customer mindset, the consumer mindset. Andrew is watching from work. That's awesome. Good to have you on, Andrew. So we have a question on why would we use this versus a low interest credit card or a low interest loan? Good question. Okay, so I did cover this last week. I'll hit this really quickly. So on the scale of interest, in the middle, we would have 0%. Here we would have 1% interest, negative 2% interest. This is all interest we're paying, right? And let's say negative 5%. Generally, anything, depending on what it is, generally anything cheaper than 5 is considered a low rate, right? So if you can get a mortgage at 2 or 3%, you're like, oh, that's a cheap interest rate. If you can get a car loan at 3%, oh, that's a cheap interest rate, right? 5% is kind of moderate. If you're at 6, 7, 8, whatever it might be, then you're like, okay, this is getting expensive, right? So people look at this and they're like, oh, a 1% interest rate or a 0. I'm going to do a 0% interest rate. That's a great rate. Okay, well, 0 doesn't cost you anything, but it also doesn't make you anything, right? So on the other side, we have earning interest. We can earn 1%. We can earn 2%, right? All the way through. And so when I'm looking at taking a loan, if I take a loan against my life insurance policy and I've designed it correctly and everything is put together right, we just talked about we can make a 2% profit spread between what my dividend and interest rates are when I take a loan, right? So I'm borrowing money at positive 2%. So the question becomes, do I want to borrow money where I get paid 2% to do it? Do I want to borrow money where I get paid nothing to do it, but I want not charge anything either? Or do I want to borrow money where it costs me a little bit of interest to do it? I would rather get paid 2%, right? So that's that. I mean, the interest rate thing, like this is again consumer land, right? I want to make money, not pay money. I want to make money, not pay zero or earn zero, right? So I'd rather have that positive 2% there. Good question there from Nano on that. All right, we have a question from Avery. Let me bring Avery on live here too. Hey, Avery, what's up, man?
Hey, what's up, Jerry?
I'm good. What is your question?
Yeah, my question for today is, how specifically do you determine what interest rate that you pay yourself back with when you're borrowing from your policy to do a larger purchase? I'm very well aware for a vehicle, for example, you're going to pay usually 2% of the purchase price back to yourself. For other larger purchases, are you going to take what the institution would have charged you, or is there more of an optimal range of the interest rate that you're going to pay yourself back with your loan?
Yeah, I see what you mean. So this is a good question. This is a little bit more technical, but let's say, for example, this is a really good example to use too. Let's say that I was going to spend $10,000 on personal development, and I know that that's going to help me increase my income. So I take a policy loan, right? And so I want to pay myself back. Avery is saying you want to pay yourself back always, right? So what I'm going to look at is one of three things. I'm either going to do a principal and interest loan, and I'm going to mimic what I would pay at a bank. If I were to go get a $10,000 loan from the bank, what would they charge me? And I'm going to base my payment off of whatever that would have been, right? So let's say that that rate would have been 5% if I would have went to a bank. Then I'm going to quote unquote charge myself 5% and pay myself that same dollar amount payment back on my $10,000. That's the first way to do it. The second way to do it is by timeline. So let's say I'm like, okay, I want to pay this entire thing off in 5 years. Okay, I'm going to take the total cost. I'm going to divide it by 60 months, and then that's my payment. I'm going to pay myself that at least every month for 60 months. And then the third one is going to be percent of balance, right? So I could say like, kind of like with a credit card, they'll be like your minimum payment is 2% of the balance. If I wanted to do it that way as well, I could be like, okay, I'm going to pay myself every month 2% or 3% of the balance. The fact is that you do pay yourself back, not necessarily how, right? So as long as you do, whichever method makes the most sense, what it really comes down to is like what fits your payment budget. Paying back a loan with the sacred account policy is the same function as saving money because you're putting it back into your account. It's liquid. You can borrow against it again. It's fully under your control. So it comes down to, okay, I did this. How much more money can I save now to refund or to repay that loan? All right, we have a question here from Casey. All right, let me bring Casey on here. All right, we are live with Casey. How are you today, Casey?
Hey, good, Jerry. How about you?
Hey, I'm good. What is your question?
So I know that companies can own sacred accounts because we've all heard of bank-owned life insurance, right? But I'm wondering, a friend of mine and I are starting a business, and for financing startup costs, would we be able to have a business-owned sacred account to pay for our startup costs, or is that something that a more established company would need to have?
Yeah, really good question. So generally speaking, when you do a business-owned sacred account, they are going to want to see profit and losses. So it might be a little bit harder to do with a startup. Not impossible, but it's going to take a little bit of extra time. So I mentioned when we're setting up a policy, they're going to go through the financial review side of things. With a company, they're going to want to see profit and losses. They're going to want to see your financial statements. So, if you don't have financial statements, then they might ask, okay, well, where's the money coming from and how can we guarantee it's there? Then they might dive into your personal income anyways, just to make sure you personally could fund the policy. And so that's probably what would happen there. So it's not impossible to do. It does take a little bit more time. The benefit and reward is if you own it through a company, especially if you are making good revenue, your contribution limits are much higher. And there's also a lot more you can do from a tax standpoint. So like we're working with a client right now on something called a non-qualified deferred compensation plan. His company can set up a sacred account for him, defer his compensation into it, and get tax deductions and tax deferral on what he's going to put into that account. But he's already got existing revenue and profit for that. So we can definitely take a look at something like that, Casey, and just see what the answer would come back as. Does guardian require medical on a child? Generally speaking, no. I think the medical exam, I would need to check at what age they start doing medical exams. I think it might be over 18. But if you're a child, they are going to look at, or if you have a child, they are going to look at medical records. So they're still going to look at HIPAA. They're going to talk to the doctors, get the medical records from them. They probably won't do, blood, urine, spit swabs, that kind of stuff. I think that happens only when you're 18 years or older on a policy. All right, questions here. Another one came in from Nicholas. How much cash value will be invested into the sacred account before moving to the premier account? So what he's asking, we have what's called the sacred account light. We designed this specifically for paying off debt, right? So this is going to be the main thing we do. And then we have something called the sacred account premium or premier. This is more for investing, right? So it's not so much, Nicholas, about how much you have in cash value before you move into the premier account. It's more, did you pay off all the debt, right? And if you did, great. Now let's set up this other one, and we've got now 2 of them rolling. Susan asks, what happens if you die and have not paid yourself back? So if you die and have not paid your loan back, it just gets subtracted out of your death benefit. So if I have, let's say, $2 million in death benefit, I had an outstanding loan of $100,000, they're just going to pay out 1.9 million to my beneficiaries instead of the full 2 million. And that does get paid out tax-free, obviously. Also, insurance companies have all kinds of fees if you take or sell a life insurance policy to someone else. So everyone does have fees. I'm not quite sure what the question is there. But the returns we talk about are all net of fees. So that 3 to 5% is after all of the costs, fees, everything. That's actually what you're netting and making at the end of that. What was the third point? Okay, so Michael Stock asked, you covered, 3 points, paying off debt, making large purchases. The third one is investing, which we won't cover this week just because we don't have time. But you can invest, you can do real estate, you can do all sorts of cool things with your cash value to generate passive income. And that's something that we can talk about another time. Let me just check and see if we have any other comments or questions here on Facebook. All right, I don't see anything. Good. So we'll go ahead and wrap up here for today. Really quick, guys. Again, if you do not have a copy of the book, actually, one more question just came in. Does your MEC reset at the calendar year or the anniversary dates? At the anniversary date. Yep. So every year you have an annual contribution limit. If you meet that, you can't put in more money till the next anniversary date of your policy. So if I signed up, let's say on October 29th, and that's the day that my policy got issued and funded, every year on October 29th, that's going to reset for me. So that's something that you want to keep in mind. All right, so guys, really quickly again, if you do not have a copy of my book, Blueprint to Financial Freedom, I want to make sure you grab this. If you're not yet a client, this is the easiest way to become one. You can go to jerryfetta.com/B2F promo. And again, this is going to be free. You cover your shipping. This does come with a course supervisor who will make sure that you go finish the book, you get your questions answered. It also does come with a coaching call with my team. And so you'll be able to actually get on live with Rod or with Nano and get your questions answered. And then we'll help you implement the steps in the book too. So as you're going through it and you're like, okay, cool, I'm ready to set up a sacred account. How do I do that? My team will help you do that as well. So again, go to jerryfetta.com/B2F promo. That's all that we have for today. So just really quickly, we do have this again next week, Sacred Account Saturday, 1 p.m. Eastern time. And then also we have Money Monday with Nano Aquino. That's going to be 4 p.m. Eastern time. I believe Nano is still going through Liar's Poker. Facebook blocked Nano's personal page last week because they didn't like literally he was telling the truth about what happened in 2008 with the mortgage crisis, and they censored his Facebook page. So we'll be going live from the company page. I'll share it on my page as well. Nano just confirmed it is still Liar's Poker, so he'll be going through that. Otherwise, guys, have a great weekend. Have a safe and happy Halloween. If anything scares you this weekend, it should not be your finances. And if that's the case, reach out to us. We can bust the ghosts with your money. That's it though. Have a great weekend. I'll talk to you guys next time.